Hello. Hello.
Hello, ma. Good evening, ma.
Good evening. I just asked a question and nobody is answering. What is happening?
The
I see.
memorandum of waste book.
Okay.
We use it for rough
Okay.
note of all
Oh,
transactions
thank
made
you.
in
Yeah.
chronological order. The second one is the journal,
Okay.
which is a subsidiary record of debit and credits.
Okay. And the third one is what?
The ledger, which is the main book of
Okay.
accounts.
Thank you. What
Welcome.
we have to know is that this, from Lucas' era till today, we are still practicing these records. Do you agree with me?
Yes,
Presently
ma.
in accounting, we still have what we call day book, which is the memorandum. Then we still have these journals. Sorry, the journals, we still have that journals now, which where you now have your day books. When you're talking of memorandum, that is where you record the initial transactions, the rough work. It's just what our source document is serving now. Our source document, if you can still remember your source document, that's what is serving now. Then when you're now talking of journals, you now talk of your cell journals, the day books. Then you now talk of the permanent uh, um, book of accounts, which is the ledger. Is presently we still have these records. Then there is another question. I said, how many sections does Lucas' book has? How many sections? Or you can say how many topics? I don't know whether I gave you this one the other time, but let me answer the question because that is very, very important. I said that Pasolini's book that it has 5 sections, and the one that concerns us is bookkeeping. That Pasolini's book has 5 sections, but the one that concerns us is bookkeeping. The 5 sections or topics are given as I want to state them now. One, we have algebra and arithmetic. The first one is algebra and arithmetic. The second one is their use in business. Their use in business. The third one is the bookkeeping, which is the one that concerns us, accountants. This bookkeeping, this contains 36 short chapters, and the name is the Computis et Scriptoris. I will come again. I say that the bookkeeping contains 36 short chapters, and the name is the Computis et Scriptoris. Then the fourth one is money and exchange, whereas the fifth one is pure applied geometry. These are the 5 sections. They are the 5 sections that this Lucas book has. Then there's another question that I would like to ask, which is what informed Pasolini in doing these things? If you can remember, I said that what Pasolini did was to document the system of bookkeeping, not that he was the first to invent it. And the question now says, what informed this Pasolini in doing these things? The things that inform this man in doing these things are that a trader needs 3 things to survive. Pasolini has it in mind that a trader needs 3 things to survive, which are: one, cash or credit. Cash or credit. You can call it the capital that the trader will need to start up the business. Then the second one is bookkeeper, who is somebody that will record what you have done. What have you done in your organization? It needs a permanent record, or it needs to be recorded, and it has to be recorded by a bookkeeper. Then the third one is an accounting system, which is a system of keeping his records. That is a way of keeping track of what you have done. So these are what informed this man in doing what he has done in the history and development of accounting. Please, I have my reason of going back a bit before entering that of today's topic, and I believe I'm communicating.
Yes,
My
ma'am.
communicating.
Yes, ma'am.
Okay, that's very good. So today we will look at the accounting principles, postulates, or concepts. Accounting principles, postulates, or concepts. These are what we already know. We are just to refresh our memory. And I believe since you have the material, you must have been going through your materials. You must have been going through your materials. In accounting, there was no theory before the practice. In accounting, there was no theory before the practice. Thus, accounting came into existence without any unified body of theory. As we saw in our previous lecture, that at the early time, people were practicing accounting without any principle. If you can refresh your memory on what we did last in our last class, you see that people were practicing accounting without any principle, without any postulate, or even any rule governing the practice. They were just practicing it, but there was no rule that will state this is how you have to do this one, or this is how you're supposed to do this one. So until this 1494, when this man called Luca Pacioli now said, this thing we are doing, let us document it. And that is why Luca now said that he was the first to document it. That is to document this bookkeeping system, and not the first to invent it. What he's saying is that it has been in existence, but nobody has documented it. Nobody has put it in black and white, or they were just practicing it. So we can now say that the difference between accounting profession and other profession is that accounting profession emanated from practice before theory, while others emanate from theory before practice. Please, this is very important. In accounting, we've been practicing accounting without any unified body of theory, without any rule or any principle guiding what we've been doing. But in some other profession, you now see that you may have a theory that can now be supported with a theory that the practice will now support, or rather the theory that can guide what you have to practice in that profession. But in accounting, at the early stage, we were practicing accounting without any unified body of theory. Am I I hope you're getting what I'm saying. So now, what is now this accounting concept? What is accounting concept? What is accounting concept? Accounting concepts are the agreed practices that underpin the preparation of accounting information. Accounting concepts, or you can call it accounting postulates. These are the basic structures, the fundamental rules, that is the general assumptions and the framework upon which financial transactions are recorded and financial statements prepared. So it's this accounting concept that guides the way we now record our financial transactions and the way we can now prepare our financial statements. We have, there are several accounting concepts. One, we have going concern concept. Going concern concept. What is this concept all about? The assumption is that the business unit will operate in perpetuity. In other words, the business is not expected to be liquidated in the foreseeable future. That is to say that the business should continue to be operating, is not expected to liquidate or wind up. That is what this concept is all about. Hence, non-current assets are recorded at fair value of the asset on the acquisition date instead of liquidation or realizable values, and then being depreciated. That is why you now see your non-current assets, you now record it at the fair value of the asset on the acquisition date, the date you acquire the asset, the fair value of the date you acquire the asset. That is when, or the cost, the amount that you record against that non-current asset. Then what of business entity concept? That is another concept in accounting, or you can call it entity concept. Entity concept is of the view that business is quite distinct from its owner. Business is treated as being separate from the owner. Like as you are now, you have an establishment. Maybe Henry, you have an establishment, and in that your establishment, or in that your firm, you, maybe your cousin or your sister may require that, may ask you, please, uncle, if you can help me with some amount of money. Then you cannot just go to that your business and take it away from the business and now record it as part of the expense in that business. No, that one is your personal affair. You have to treat your personal affair as being different from that of business affair. So when you as the owner withdrew or take some part of business money which you don't suppose to, just to take your private affair, that thing you cannot term it the expenses of the business. Instead, it can be your personal drawings. So you must treat the business affair as being different from your personal affair. That is what this entity concept is all about. That a business is seen as being separate from the owner. Then the next one is matching concept. Matching concept. This concept holds that for any accounting period, expenses must be matched against revenue that they help to generate. For any accounting period, I hope we understand what is accounting period. Like
Yes,
if the
ma'am.
accounting period of a particular company, if it's maybe 31st December, it may be that of 12 calendar months. So if it's from January to December, 31st December 2000 and whatever, that is the date, accounting period of that. So the expenses that you have to record that you have to enter in your, what's the financial statement that was supposed to enter our expenses? Who can remember?
Income,
Who can
statement of
remember?
income and expenditure. Another, I forgot.
Okay, you've tried. Before we do call it profit and loss account. That is before the IFRS. But now, if you call it profit and loss account, anybody that is close to you is supposed to slap you because you're no longer, you don't supposed to be in that class of accounting or accounting class. We now call it statement of profit or loss, and other comprehensive income.
Income. Okay.
So thank you. So in that statement, or in that financial statement, all the expenses that you have to enter there must be matched with the revenue that it helps to generate, and not when you now bring expenses of this year, you now go and record it or match it with revenue of next year. This is against the matching concept. So this concept is of the view that for every accounting period, expenses must be matched against revenue that they help to generate. So the next one is duality concept. Some may call it dual concept. And what is it? This refers to the double entry system of record keeping. That for every debit entry, there must be a corresponding credit entry. In fact, there was an interview that I went one certain time, and the question was that you should explain. The interviewer said accounting is a two-way trafficking. Explain it with accounting concept, with an accounting concept. This question, you can see some, if you see something like this in your exam, I hope you have something to write. Is it difficult?
No,
Is the
no,
question difficult? I said that accounting is a two-way traffic, a two-way trafficking, that you should explain it with the aid of an accounting concept. What this question is just telling you is duality concept. Is talking about duality concept, that it, this concept refers to the double entry system of record keeping, and you must tell us that for every debit entry that there must be a corresponding credit entry. That is what accounting is all about. If you have you the giver, and you now have the receiver, one is being debited whereas the other one is being credited. So that is what duality concept is all about. Then we have another one, money measurement. Accounting deal with only those events which can be measured in monetary terms. In fact, in accounting, anything that is not in monetary terms, we are out of it. We only recognize transactions that can be measured in monetary terms. For example, now when you have your in your organization, and an event happened, maybe somebody came to the organization, and somebody was working in the factory, and had an accident with the machine. The machine maybe cut off one of his fingers as an accident in the factory. That event, all these explanation in accounting, they are not useful to us. What is useful in accounting is, after that man must have cut off his hand or his finger, then what is the cost effect to that organization? Measure whatever that you have stated now, the statement or the man that has cut off his finger, what is its cost effect to the organization? Accounting may come in now, when you now say the man after cutting off his finger, we have to, the management, we now took him to the hospital, and the hospital charged so amount of money for the treatment of that thing, and the organization is taking it as part of a personnel, maybe welfare or so. The cost effect, what is the amount that the hospital charge? That is maybe 20,000 or whatever amount. That is where accounting will come in. But you saying that the man cut off his finger without measuring in monetary time, accounting is not talking about that. Anything in accounting must be measured in monetary terms. Then we have another one, realization concept. Realization concept. This concept states that revenue is recognized as soon as goods are passed to the customer in exchange for valuable consideration. That revenue is recognized as soon as goods are passed to the customer in exchange for valuable consideration. Then the next thing we have to enter is the accounting principle. What is accounting principle? Accounting principles are guides to the action of the accountants in preparing financial statements. We say that accounting principles are those things, those guides that the accountants will now look at when they are now preparing the financial statements. They are also rules that accountants must follow when it becomes necessary to exercise judgments about the choice and application of conflicting fundamental concepts. Some of the accounting principles we have one, prudence. Prudence, I think this prudence, was it prudence that anyway, that came out in their last semester exam. But whichever way, the major thing you have to know, this is an MBA. You know the principle, know the concepts, know the meaning of them, and how if a question comes in form of maybe like a case study, and you were asked to use an accounting concept or an accounting principle to show your understanding of that case study given to you, you can now be able to determine the particular concept or principle that you can use to match that case given to you in exam. Nobody can tell you at this your level, define prudence principle or what are the accounting principles. No. At this stage, when you know the meaning, then if a case is given to you and you're now asked to use an accounting concept or use an accounting principle to explain that case or to show your understanding of that case, then you can now do it. But you can only do it when you must have mastered those accounting principles and also accounting concepts. So some of the accounting principles we have prudence. Prudence. What is prudence all about? Prudence means being sensible and careful when making judgments and decisions, avoiding unnecessary risk. This principle says that income should not be anticipated and all possible losses must be provided for. Yes, in accounting, we don't anticipate our income. Like if he that is here now, maybe somebody promise you to that in the organization you're working, maybe your boss or the owner must have stated that you to reward you of what you have been doing or your efforts, that you have an increment in your salary. You know, you have this in mind that maybe if your salary may be, I don't know, but I'm just taking it as an example and not that that is your actual salary. So if your salary is about maybe 80,000 naira and the man must say that you have an increment in the salary, you may now say that maybe from 80,000 I may earn 100,000 this month. Spending your money, anticipating that this income is coming, and that is why you promise your mom that you bring so amount of money to her, promise your sister, promise this person based on that income. that is coming to you, or that's your salary that is coming to you at the end of the month. In that sense, you have anticipated your income. In a accounting, what we have to do is you make provision for possible losses. You make provision. That is why we now have our bad and doubtful provision for bad and doubtful debts. Somebody that is owing you, or people that are owing you don't know whether they all will pay. You don't know the debt that can go bad, that can be bad, and the ones that can still pay. And for that reason, you can now make provision for those bad and doubtful debt, can make provision for losses in accounting. Then, when you now realize the actual, maybe those people that are owing you now later turned out to pay all the money, you now see yourself that the provision that you must have made, you now compare it with the actual one that they have paid to you now. That is where you now know if you have profit or loss, or rather whether you have excess on the provision that you have made on bad and doubtful debt, or you have shortage. And that is where you can now record it as income or as expense, as the case may be. So it is better to make provision for losses in accounting, and also not to anticipate our income. And that is what this prudence principle of prudence is all about. Also, in this principle, given a choice between two methods of valuing an asset, the accountant should choose the lower value. So simply put, lower asset valuation and higher liability recognition. That is also what prudence principle is telling us. Then the next one is consistence. Consistence. Principle of consistence. This states that similar transactions within the same period, and between one period and another must be dealt with in a consistent manner. That methods must not be changed at will. No, it's not whenever you come out any day you're preparing your financial statement. Maybe you have a particular method of depreciating your non-current asset. You have a particular method. Let's just use plant and machinery as an example. And maybe you're using straight line method for the depreciation of your non-current assets now. Then that has been what you've been using. Then in another year, you now decide to change that method, maybe from straight line method to reducing balance method now. This principle is telling you that you should not change method at will. No. Why? Is because you have so many users of that your accounting information, and that may mislead some of these users of accounting information. Because if you're using this particular method, and this year, next year you now use another method, you may have discrepancies or differences in your profit or loss, as the case may be. That is the end product of your statement of profit or loss and other comprehensive income. You may have either profit or loss just because of that method that you've changed. And somebody that is trying to analyze your financial statements, maybe the person wants to trace the trend, uh, compute a particular ratio for a particular year. Then the same ratio, the person may try to compute it for a next year or another year. You now see that due to that difference in your methods of depreciating, it can change or bring some discrepancies in either the profit or the loss. Some maybe a profit or loss account that's supposed to have profit, due to that method that you have changed, it may now end up having loss instead of profit. So this particular principle is saying that you should not change method at will. But if there is need for you to change method in a case that the company or the management or the person preparing the financial statement, the accountant, now have need to change the method, there is need for you to change the method, you must disclose it. It must be fully disclosed in your notes that you have effected such change, and that will now help to not to mislead the users of this accounting information. So I believe this one is very clear. Then the next one is materiality. This principle holds that only items of material values are accorded their strict accounting treatment. In other words, materiality principle is concerned with the materiality of amounts and information provided. Any item or amount or information which its omission may mislead the users of accounting information is considered material in accounting and should not be omitted. So something that is material to a particular firm may be immaterial to another firm. So there is no yardstick for you to measure that this amount is material. For example, if you have an establishment, maybe a sole proprietor, when you now lose like 100,000, sorry, like 1,000 naira, it may be immaterial to you depending on your establishment. But there's another establishment, for example, in the bank, somebody, the teller just mis post must have misposted a particular amount, maybe just 100 naira. You see, measure 100 naira with 1,000, the range is very much. But to that sole trader, that 1,000 naira is maybe material to him, but to that bank, that 100 naira that the teller could not account for may be material to them. So what I'm trying to say is that something that is material to a firm, to a particular firm, maybe firm A, may be immaterial to firm B. But how do you determine that something is material? Any item or amount or information that its omission can mislead the users of the accounting information is considered to be material in accounting. So now the next one is principle of objectivity. Principle of objectivity. This principle connotes independence of judgment on the part of the accountant preparing the financial statements. This requires that accounting entries must be supported by verifiable evidence so that the users of financial statements must have confidence on the report. Such evidence include we have invoice, we have checks, we have vouchers. So this principle of objectivity is just that all the information that you must have prepared in your financial statement, they must have supported evidence. Let's just assume that you have a what do we call plant and machinery of 20,000 naira. If an auditor or somebody came to you and said this 20,000 naira you have as plant and machinery cost, how can you tell us that this is actually in existence? Then you can now be able to bring this is the receipt of the purchase. So it must have verifiable evidence, and that receipt, if the auditor or the person that is asking wants to verify, person can go ahead to investigate on the names, the amount that are therein. So in summary, the postulates are the antecedent conditions or essential prerequisites to principles. I'll come again. I say that the postulates are the antecedent conditions or essential prerequisites to principles. The principles must meet the text of the postulates, and the practice must be supported by the principle. So now, if you're asked, if you're given any case study and asked to explain or show your understanding with an accounting principle or an accounting concept, I believe you can confidently answer such question if you see such thing in your exam. I would have loved we continue the lecture, but as I'm seeing here, we just have few students, and that is not encouraging at all. It's not encouraging. If it's just to record, we can as well. I can as well just teach. You record. I and the maybe the person that is operating it, maybe Harry or anybody can record and still pass across. No, there is need for us to meet. There is need for us to meet so that we discuss, we share our view. You ask your questions, and I can also ask you questions. If not, you have your materials, you can just read up and come to your exam. But that is not enough. I'm telling you, if you just read only what you have as your material without coming for the class, I'm telling you that you cannot have 100% on this course, or rather, you can't even have up to, do I say, 70%, because almost my question used to come from what I teach in the class. That is why when I'm teaching, you still see some kind of questions. I'm not telling you that the questions I've asked are your exam questions, no. But when somebody is teaching, the area of emphasis, then you can now ask your questions and it will now be an interactive class. But looking at the people here in, I don't really know if it's because of the rain or because of the network or technological problem that we had at the beginning that delayed the lecture. But I am just asking, I'm pleading that we should just try as much as we can to be at to attend the class or the webinar. That is very important. So I think on this note, we have to end the class here. I would have loved to continue, but the number is not encouraging. So in our next class, we'll continue from where we stopped. We can now look at the financial statements and the users of the financial accounting information. Look at the users of accounting information, the concept of financial statement, then the uses of this accounting information, and we can also proceed. Thank you. If you have your question, you can ask. I can see Ify one more. But Ify, I must say that you're really trying.
Thank you,
You
ma'am.
don't play. You don't play with the lecture. I think you participated also in our last class, and today again, we were up to 5 or 6, but I just witnessed that we are just 2, or rather 3. I making it 3. So, and it's not encouraging. So please, Henry, you can help us to advise others to try to be joining for the class. This is an accounting course, so it's not what you can play over. It's an accounting course. It's something that's supposed to be there when we are taking them one after the other, so that you don't have problem in
Yes,
answering
ma'am.
your question in your exam, and also putting it into practice in your workplace. So if you have question, you can ask.
Okay,
You
ma'am.
have question.
Um, I want to thank you for this lecture. Thank you so much.
Okay.
Then also, please, I think why most people are not here, I think, is because the information came late to us. Yes, ma'am.
Okay.
So if they cannot at least give us, even if it's 24 hours notice, it will help people to plan themselves. You know. So I think that's the major reason why most people are not here.
Okay, he informed you not long.
Not long ago, ma.
And
We just got information a few hours ago.
Okay,
really?
I think that was
So
because
Henry, you don't know.
we assume that the timetable is already there because I work with the timetable. But going
We don't
forward,
even
I'm
have
going
the
to be.
timetable.
Oh, apologies. So going forward, I'm going to be trying my best to be giving you heads up at least a day before. Sorry about that.
Okay, that's fine.
Okay, that's okay. So if
Yeah.
you thank you for the observation.
Welcome, ma.
All right. All right. So on this note, we have to end the class.
All right. Thank you
So
so
good
much, ma.
night, everybody.
Yeah, good
Good
night,
night,
ma.
ma. Good night, Harry.
Good night.